All good. All right, guys. So we're recording now. Sorry about those technical difficulties. That has never happened. So hopefully it won't happen again. Can you just let me know that you can hear me okay like this, or if it's too loud, or because I'm currently speaking right into my phone. So if it's too loud, if you want me to put it a bit further away so that it's not that loud, or if it's clear enough, then let me know. All right, perfect. Wicked. All right, guys, as well, I'm going to be honest, I'm not very happy with a lot of you. I'll tell you who I'm happy with. I'm happy with Richard. I'm happy with Simon. I'm happy with Tina. And I'm out in you guys. I'm happy with Emily. And that is about it. I mean, there's 34 people on this Zoom. If you haven't been on a Zoom with me before, then you're excused. If you have, then I'm holding you accountable for this. You should, unless you're sort of, I don't know, unless you didn't want to put in the chat box or whatever, then you should have been watching the steady guys in particular. I'd rather you watch the steady guys than my previous Zooms. So if you didn't watch my previous Zooms, then that's okay. But if you have been watching steady, or if you haven't, then you need to watch it every single day. You need to be watching at least 1 hour of steady, just one session. That's it. And it doesn't matter who you want to do. I'd recommend starting with Starboy, and then once you've got through Starboy's favorite sessions, then feel free to move on to John Dollery's favorite sessions. And then from then on, you can watch them. They're on every single. Starboy's on at Wednesday at midnight, so it's technically Thursday, and John Dollery is on Wednesday. Starboy's on at midnight, and Sunday night at midnight he's also on. And if that doesn't accommodate your needs, you can watch it in the morning or whatever the next day. And John Dollery is also on at Tuesday at 9 o'clock and Thursday at 9 p.m. So there's really, you're only sleeping on your own success, guys. And I will say it is as simple as that. So I did say that today is going to be mainly focused on, in the last session, if you were on it, I said that today would be focused on mainly just looking at some actual trade setups, giving you guys an idea of the potential. And yeah, basically that's it. The last couple sessions were kind of education based. So this one is going to be more delving right in and looking at some setups that I've got set up for the week. And yeah, just having a look. You might even catch some setups if you're lucky and if you're taking enough notes. So yeah, let's get into it. So we're in January, and January is a big one for trading. I don't know if any of you were trading live or trading generally in sort of November and December, but notoriously November and December are quite rocky months for trading. And the reason being because the big institutions, the big guys that move the markets, they are not in the markets. And if they're not in the markets, there's not as much money in the markets. And if there's not as much money in the markets, there's not enough pips, or not as many pips to be made. You can still make pips, but yeah, it's notoriously much more difficult. So now we're back into January. We're back into full swing of things. And yeah, we're finding some really good setups quite regularly. So this particular trade, this was actually sent out on steady. I funnily enough, and this is how powerful the strategy can actually be, I literally marked this up absolutely like to a T, in terms of the entry, and almost like near enough the same stop, and very similar take profits to John Dollery. So when you start to really look at these setups and study them and mark them up and stuff like that, you realize how powerful it is. And then once you start to actually have similar setups to the very educators that have taught you the strategy, is powerful, and it's a nice feeling. So yeah, again, I want to just say, make sure you watch and just smash it out, because you'll reap the rewards. So I'm going to talk you through this little setup I've got here. I'll jump straight into the 4 hour, because the 4 hour is probably the best. So guys, we're looking at a few main things here. I'm not sure if you guys will see much, but pretty much a lot of the concepts of steady. This is quite a good setup in terms of the concepts of steady. So straight away, what I can see here, I'll highlight here. This is called an institutional candle. And what institutional candles are, if you've watched my videos, if you're new here, then I'll let you know, they're basically either buy to sell candles, so a big buy before an instant sell, or they are sell to buy candles. So the same in reverse, essentially. And what they basically are the big banks and the big institutions. They're pumping millions and millions and maybe even billions of pounds into the market so that they can get it at a discounted price to start with, and also so that they can get it to certain points where they've had positions in. Because what they'll do is they'll let's say, where will they have positions in? Just for example, for argument's sake, let's say they push the market up here to get it to this point. They manipulated it to cause this to happen. What I can see here is some form of equal highs. So they've created this to basically just cause sort of cause people in the market to, maybe they might put their stop losses above here. Once they see the sell-off, they might put their buy stops here. They might have sort of money here. So it's basically a point to get back to in the future. But what it basically is liquidity in the market. Whenever you see these kind of equal highs and equal lows, you're going to see that there's liquidity in the market. There's going to be liquidity under these, so stop losses and whatever, like I said. So the institutions, they will push the market up to certain points where they've been in trades, because they hedge positions, so they'll be in multiple buys and sell positions. They'll be so for example, this is a perfect example. I'm not sure what happened there, guys, so bear with me. Sorry, my bad. Sorry, guys. So this is a perfect example of what has happened. They will have pushed the market up to this point for some reason or other. And then what they've done is they've pushed it up, got out of certain positions, and also added more. So got out of certain buy positions that they might have been in, and also added more sells. So that's caused a big spike in the market. It's caused a big sell down. And with the institutions, they have to do this. They have to have hedged positions, because if they didn't, then the market wouldn't move in the way that it's supposed to. It would you just see like 2,000 pip spikes in 1 hour and stuff like that, because they have so much leverage, and they have so much liquidity and equity that they can put into the market. So what has happened here, it has bought up and they've just sold it off. They've manipulated the market. They've tricked people into maybe thinking, you know, your standard, you might have a support line here. You might have whatever, you know, a resistance line. Any sort of strategy that you might have. You might be trading a breakout. You might be trading maybe a W, if you like DAX. You know, there's a lot of different strategies that you could basically be trading, and they could manipulate the way that your strategy works. So they've tricked people, basically buyers, into buying the market. A lot of buyers would have jumped in here, especially newbie traders, and then they've just literally taken everything out. Everyone's going to be panicking at this point that have been in the buys. They're going to be thinking, "Oh crap, what have I just done?" But yeah, so they've sold it all the way down, and then it's kind of filtered out here. Here you can see there's a lot of wicks, and basically wicks just means liquidity. If you're seeing a lot of wicks, or if you're seeing really big wicks or an accumulation of wicks, then it just means that they're building up money, or they're taking out money. So you'll often see big wicks at the top of moves. And so what I can see has happened here, it's sold off to a certain point, retraced, sold off again, and in this retracement, it's created a lot of equal highs. So there's a lot of build-up of liquidity. Don't know why it keeps doing that, guys. Update later. So if you just drop down one sec to the hour, you can see here that the price keeps trying to break up above this. It keeps trying to, but it keeps failing. So, I mean, the banks might be trying to push it back up to their positions, but it keeps failing and, you know, selling down. But either way, at some point, the market wants to come back to this original point where there was the big buy before the sell, because there's some people that will still have their positions in. So they're going to want to take their positions out. And this is the big institutions I'm talking. So what has happened here, there's been a build-up of liquidity, hence the dollar sign above. It's sold off again. And if you had been in this whole move, 250 odd pips. And then what has happened is they've just pushed it all the way up. And funnily enough, I was actually in this move on the way up. So it was glorious, because once you actually start to learn this, sort of master this strategy, you'll start to be able to take trades all the way up and then all the way back down again. And that is just what the banks do. They're laughing. They're absolutely laughing. So just over here, there was a institutional candle, similar, a sell to buy candle, right about here, around about there. And I got in around about here, and I actually knew that this was going to happen. So I actually had my TP just before this institutional candle. So I think I must have had it sort of around about, I think I had it at 300. So I made a nice 150 pips on the way up. And I just simply set a sell limit around here. And what these institutional candles can do is they can basically be played off in two different ways. And that is at the open of the candle and at the 50% of the candle. And the reason for that is that in these candles, there is a huge amount of volume in these candles. So and I'm dropping nuggets here, guys, so I hope you're taking notes. There is a huge amount of candles. There is a huge amount of volume in these candles, and the most amount of volume that there's going to be in the candles are at the open of the candle and at the 50%. So the bank's positions essentially are going to be at the open and the 50%. And just a quick tip, to mark up the 50%, I usually use fibs. And I've got a template saved, and I'll just mark up the precise entry of the 50%. And so going back forward, what you can see here, you can see that this candle was at 1.68764. That's the precise entry of the 50%. But John Dollery and Steady, they like nice round numbers, and so do the banks. So I've rounded it up essentially to 68770. And so what this trade is now projected to do is tapped us in here very nicely. Currently floating about 40 pips in profit. And I think the first take profit should be around about here at 150 pips, but it could also be maybe a bit lower, maybe about 50 pips. I'm not entirely sure on the first take profit, but if this was my own personal trade, I'd take partial profits around sort of this area and just secure around 50 to 60 pips. And then my first official take profit will be here. And what this is an area of imbalance. So it's an area, I mean, prior to this little push here, it is an area where the market has just pushed all the way up, and it's left volume, and there's nothing that's filled it essentially. So imagine this didn't exist, and we just had this candle here. There's a huge amount of volume in this candle, right? So the market will always have to be refilled at some point. So no matter what, in the range the market is in, it's going to have to be filled where there's been areas of imbalance and areas of displacement. They're always going to have to be filled. So this particular instance happened sort of not long after, but it can be sort of months, days, years. But basically what you should take home and take away with you is that it's got to be filled. Areas of displacement and imbalance, it's got to be filled at some point. So they're good areas to kind of target going forward. And also my second take profit would be around the institutional candles that are next. So there's one here. The green lines are essentially where they are. So there's one here and one here. And let's just see. And what I would maybe do, what I usually do is I'll fib up the whole move. I'll fib up the whole move, and you can see here that this has actually reached our golden pocket area. and in particular John Dollery's golden pocket area, which is in between the 78.6 and the 88%. And also Starboy's kind of golden pocket area is between the 61.8 and the 78.6. So that's another little nugget just to let you guys know. But it's filled in all the way up to the 88%. It's rejected off of that. And basically what these guys will usually do is draw up a measured move from the start of their move to the start of their move to the finish, and usually it will end up sort of around the minus 27.2. So that's usually quite a good target. I'm not going to say take profits because it's not always going to hit there, but it's a good target to kind of get to around the minus 27.2 on the fibs. So that's a nice kind of 280 pip move. So moving on from Euro NZD, we'll take a little look at okay, so guys, yeah, this one I actually marked up sort of around about 2 weeks ago, actually. I think it was on the It was on the 13th of January that I entered this trade. Around about here. And on the 13th of January, I remember talking to, I don't know if anyone's on the trading floor here, but I'm going to also state it here and now, and hopefully I'm right. But I stated that this move, I projected it to go 700 pips. And guys, if you've got your calculators out, I mean 700 pips. So even 700 pips on a one lot size, that's £7,000. £7,000 just for holding a trade that you believe is going to go in your way. I mean, guys, drop some fire in the chat box if you think that's pretty powerful. I don't know anywhere else that you can do that. That you can do that amount of work for the skill that you have, and be able to, make £7,000 by essentially just sitting on a trade, knowing it's going to go that way, moving your stop loss accordingly to keep securing your profits, and just literally watching it just, fly down. So far, we're up about, we were up about 130 pips. We're now up about 80 odd pips. And I mean, to be honest with you, I expect this to kind of retrace a fair amount and then make its move down. So yeah, let's see if it actually pans out. I mean, from January to March, the 31st, that's when I predicted it should go 700 pips, because that is what's happened prior in the market. So if we go on to the weekly, you can see here that there's been some measured moves that have occurred. So just here, that's 700 pips. And then just to here, that is around about 700 pips. And the market, 9 times out of 10, will always drop down the same amount, albeit this is kind of around about here. And it will also retrace around about the same amount. So if we just have a look, I mean, it retraced around about 500 pips. And again, around about 500 pips. It's never going to be exact, but generally the moves will be equal to or greater than the previous move. So that's why, and also it correlates quite nicely with this minus 27% target just before. So that is that. And if I just talk you through a bit about my reasoning behind this, if we drop up to the daily. So what you've got here, guys, is the last up move, the last up drive before the move down. And I did mark up. Let's see on the weekly if there's any institutional sponsorship candles here. So got one there. So yeah, I think this one was on the daily. So around about there was when I got in, around about the 110 mark. So it was just the open of this institutional candle, and it did end up going past the 50%, and now it's nicely made a little move down. So moving on, guys, this is another one that correlates quite nicely with what I'm expecting. There's some areas of imbalance in and around here. There's an area of imbalance here and here. So they're all targets for the market to be pushed back down to, because it's always got to be filled. Like I said, the areas of imbalance always have to be filled. The market always has to correct itself, no matter what. And what I see here as well is some nice liquidity just here. Some form of equal lows and build up of kind of liquidity. There's long wicks. There's a lot of wicks. There's just a build up of orders essentially. So a lot of people's orders are going to be trapped here. For the people that haven't hit stop loss yet, around here and stuff like that. So that is a good target, and these are also good targets. And if I remember correctly, this hasn't actually come into play yet, but let's just see here. So there is also, so I was looking at this trade in particular on a much higher time frame. So the beauty of this strategy, you can use this on higher time frames and also kind of lower time frames. So the 1 hour, the 4 hour, 2 hour, 3 hour. But I was kind of looking at some trades on the higher time frames because I liked the higher time frame bias that it was kind of giving me. So just to have a little look, if I fib up this move. So, I mean, this move in particular, it's looking like it's going to be such a big move that it wasn't even on my trading floor, my trading view screen. But let's see. So what I see is some targets here, areas of displacement, areas of imbalance, and that is around about. So the first area of imbalance in particular is 780 pips. The first area of liquidity is around about, 400 odd pips, 350, and the second one kind of 580. So if you can kind of learn this strategy and look at higher time frames, it depends on the kind of person you are. for me, I don't necessarily think I'm going to end up holding these trades for this long. But if you're someone that can literally set and forget something and just kind of forget about it, wait, months, years, not years, but maybe up to a year for this one, you could come back in a year and just have some serious cash just sitting there, just from you kind of having a skill to be able to do that. And I think that is kind of what banks and stuff will do. I think, especially like January, that I'd assume that they would be kind of looking at trades for the year and just putting some money into it for the year, and having certain trades that they have and just having it sit there for a year. There's other trades that they'll be looking at on a daily perspective and stuff, but I mean that's what I'd do if I had that much money and had that much impact. So based on these measured moves, there has been a move down that is around about well, I wasn't expecting that. Let's see how I came to this conclusion. I'll mark this up at the start of the week, guys, so bear with me. I think it was around about here. So in around about a year and a half. I mean, this is putting things into a much higher perspective. A year and a half it's come down this amount. So, sorry guys, just bear with me. I'm not actually sure how I came to this conclusion, because I've got 2,000 pips here. Oh, okay. Now I understand. It's because of the equal lows. Okay, yeah, that makes sense now. Okay, yeah. So what I had basically seen was around about 2,000 pips here. So that's the first move. And I'd seen that this had been happening previously. So you see this move here, it's usually going to be similar, equal to or greater than the previous move. And then here, it might be similar or greater than the previous move. And again, you can see it kind of here. So the market does like to repeat itself. That's how the banks will make their money. And from here, I've basically seen this. And if on this occasion it does, based on sort of my other analysis, based on the institutional candles, based on big areas of displacement, areas of liquidity, there's equal lows and sort of accumulation here. I would like to think that this trade is going to end up targeting these lows down here, because they're yearly lows, and the market hasn't traded in this range again for a long while. So, and the market is trending downwards as a bias. It's trading downwards, and I mean, I'd like it to see. Not that I wish the downfall on the pound, but we're in the only game where you can make money whether the pound falls or rises. So that's what I'd like to see happen here. 2,000 pip move, challenge these monthly equal lows and monthly liquidity. Okay, guys. So this setup in particular, Euro AUD. This was a very textbook setup, very textbook steady setup. So I'm just going to talk you through this. So what you have here is you've got, let's drop it down to the 4 hour. Bear with me again, guys. Okay, so basically this candle here, let's make this red as well. This red line here was the open of the weekly institutional candle, and so you can see here that it was the open of this candle here. That should be around there. So this was the open of the institutional weekly candle, and as I said before, the most amount of volume is of any candle that is going to come back to and play off is the open of the candle and the 50%. So in this particular instance, the market pretty much played off the open of the weekly institutional candle precisely and has just dropped. This was also a steady alert that I had marked up previously. I think this line here was our entry, the green line, and I think it was on a smaller time frame. See the 1 hour. Okay, I'm not sure. Not sure what that was as well. My bad, guys. Basically, what it did end up playing off is, we'll delete that, and it was the institutional candle, the weekly institutional candle, the open of that. So, and the higher the time frame, the higher the probability of the setup. So if you can find a good setup on your 4 hour, on your daily time frames, they're the ideal setups. But then you can have some confluences like the weekly, a weekly institutional candle being played off, or it nearing kind of weekly equal lows or weekly imbalances. Then it's even more accurate and even more powerful. So what has happened here, what I see is, I see equal highs here. I see 1 equal high, 2 equal highs, 3, 4, 5, 6, 7, 8 equal highs where the market has come back to. I mean, here it kind of swept the highs, but again, it made the highs again, so it's valid again. So, and what is around these highs is quite a round number in 1.63. That's quite a round number, and John Dollery likes round numbers, and he says that the institutional guys, the institutions, they like round numbers. They like playing off round numbers and then being certain target points for the market to go. So you can see here, even if we kind of go back to it, you can see here that the amount of times that the market has reacted based off of these round numbers is pretty cool, really. I mean, it's reacted off of a lot of times. It's just an important number, basically, for the institutions and whatnot. So there's a build-up of liquidity here, and when there's a build-up of liquidity as well, by the way, just means money. It literally just means money. When there's a build-up of money, there's a build-up of orders in the market. The banks, their main job is to manipulate the market so that they can get as much money as they can out of the market, so that they can, in order for them to make money, because all of the markets, there is basically liquidity, and without liquidity, without money, then the markets wouldn't be able to make the money. I mean, it's a $6.6 trillion a day market, so there's a certain amount of them dollars in and above, sort of above here. So it's got to be collected before it can actually be put into someone else's hands, if that makes sense. So that is why the banks will try and push. They'll create these highs purposefully and sell off at sort of equal highs, so that sort of retail traders and your average trader will put their stop losses above here. They'll put sort of buy stops above here, because they'll think, okay, like every time it goes above here, it should buy, and every time it goes near here, it sells. So I'm going to put it just above, so that I can kind of, not get caught out. And the bank's jobs and the institution's jobs is to catch you out. So what has happened here is literally swept these highs. It's taken out this liquidity, and that gives them enough leeway and enough reason to just literally sell it off down. So I don't know if you guys have ever been caught out in a trade and just kind of placed your trades just above, like, I mean, put a 7 in the chat box if you've ever been caught out of a trade because you've put stops just above the highs or just below the lows and being caught out of it. Yes. So this way of trading takes into account manipulation in the markets, which is why I think it's so powerful. Because it's the most manipulative, industry in the world. It's got to be manipulative in order for it to make more money. So yeah, that's that. It's taken out the previous liquidity, the previous highs, and now it's kind of getting ready to make a move down. One of the targets is here. One of my personal targets is here. And this was a steady trade, so I think our first TP was actually, I'm not sure that our TPs are here exactly, because I think I can see here that there's an area of displacement and imbalance right there. So that could be a target. And also, let's see where that, I think the first TP we hit, TP1, which was around about, that was it. So it's around about 70 pips, I think. So it's around about that. My overall target for the trade is to attack these lows here, because I think that will take us nicely into these lows back here. And this is basically all liquidity. This is all money. So, and even, I mean, even these kind of relative equal lows here, there's going to be money underneath all of these. So that's why there'll be targets for the institutions, and that's why, and even areas of imbalance, there's a lot of volume in these areas as well, particularly again at the 50%. So there's going to be, so imagine you're in a trade, right? And you're looking at this from a certain perspective, and you're seeing that there's wicks here before, and you're anticipating a double top, right? So imagine here, you're in the trade, you see this wick here, you see it wick like it did here, and you start anticipating the sell. So you're thinking, okay, when it gets to here, it's going to reject again, and it's been in a downtrend, and it's gonna reject again here, and that's when it's gonna make the move down. And the institutions of, I mean, there's this might have been a news spike or something like that, but either way, they've just gone, nope, we're taking it up, and we're taking it up, and we're taking it up. They've taken it up here, and then even they've just, I mean, people would have tried to sell here again as well, and also here. They're trying to sell this whole time, and it's not working. And they've just literally smashed through these highs, collected that liquidity, collected that money, ready for the move down. And so, yeah, back to the displacement. The 50% is where the most volume of the most volume of orders is going to be. So even like, you know, even maybe some institutions might have been caught out of this, and they just basically will want to get it back to this area to delete their orders and whatnot. So that is that, guys. This is one particular trade I'm looking at right now. Just delete this. This is a particular trade I'm looking at the moment. And so after this, I'll probably try and draw up a live chart just so you can see like kind of the process of how I kind of do it. So what I'm anticipating here, you know what, guys, I'm just going to delete this, and I'm going to do it, start it from scratch so that you can see what I'm seeing. So generally what I'll do is I'll start from the bottom, the very top, on the monthly time frame, and I'll want to determine kind of what's going on at what's been going on over the last sort of years, to see, okay, what's the economy been like, what's the macroeconomics of the economy and stuff like that. And I mean, if you zoom right into now, you're looking at, we're kind of trading in a specific range. We've been trading in and around this range for the last kind of 2 years. There's been no huge spikes or huge. It's kind of been. It's kind of been in consolidation, right? It's been ranging. There's been some moves to the downside. Some big sort of. There's been months of staircasing up, and then there's just been smash down, and then there's been months of staircasing up, smash down. This has taken out. This one singular candle has taken out the previous 4 months of price action. And again here, 1, 2, 3, 4, 5. 5 months of price action. 1 month of it has just slammed it and just completely, eradicated that. So, I mean, here you can see that there's been a nice kind of like W formed, if anyone's into DAX and shapes in the market. But for me, it looks hit like here, it's rejected a lot. For me, it looks like, I mean, I could be wrong, but it does look like it's getting ready to kind of push down. The current, kind of the last year of price action has kind of told me that, from January 19 all the way to this December now. So yeah, if we drop down to the weekly. And again, we're kind of seeing a similar thing. Like, there's been a big impulse here. And then there's been the retracement. There's been an impulse again. Similar, not that similar to be fair. But there's been an impulse, and then there's been a deeper retracement. But if we're looking at the basics of this strategy, there's been a high, and then a lower low, and then a higher low, a lower low. It's staircasing its way up, but if we're just looking at the kind of the main high and low points, this hasn't actually broken structure yet. It hasn't actually broken it kind of being in a downtrend. And if we look at the daily, you can kind of see that more. And you can see that it's currently been staircasing its way down. So then if we drop down to the 4 hour, we can start to see if we see any kind of points of interest. So straight away, I mean, this stands out to me because it's the last big up move before the move down. So just as a rough little point of interest, and that's all these things are. They're just, you're trying to find points of interest and points to look back and look for the market to maybe hit. So I like that. Go up to the daily. Maybe see if we can. Okay, so on the daily, it looks much more clear. This particular up thrust candle, it looks much more clear. So you can see clearly that it's an institutional candle, because the institutions, they've pushed it right up before the sell down. And one of the reasons I can see here that they've pushed it up is because of this right here. Make this a different color. So this is the reason that they've pushed it right up to here, because it's what's happened is played off the last institutional candle before the move down. And so right here, this institutional candle has not been played off yet. It tried to play off it here and stuff like that, but it hasn't been played off. So what I would do is now that I've seen that this is kind of a nice little candle to be looking at, I'll fib it up from the body to the body, not the body to the wick. It needs to be the body to the body, because that's where the volume of the candle is. The wicks are just kind of manipulation. And I'll draw up the 50%. And also, actually, I'd probably draw up the open of this. And you can see here that the open has already been played off quite a few times. I mean, so far, guys, like Starboy recommends, he says that maybe a good idea would be to have a position open at the open of an institutional candle, and also another position at the 50%. But so far, I could be wrong, and it's down to personal preference. I mean, try it out yourself. So far, I've noticed that it plays off the 50% more often, and yeah, I mean, on higher time frames, then the open, I think, is much more kind of the open is going to be much more accurate. It doesn't. I've seen it play off the open much more times on a weekly time frame than on the 50% on a weekly time frame, and that's just because of it's got to go that bit more up, and it's not always going to do that. But definitely on the daily and the 4 hour, I would say have just maybe one position here. But that's just my experience. Try out both and see how you get on with it, because you can have a position at the open and the 50%. So it might be a good idea. But yeah, it's entirely up to you, based on your trading style and what you want to do, really. So you can see here that this has been sort of a nice area for it to come back to. I can also see that there's a slight imbalance just in between this institutional sponsorship candle. So there's a slight imbalance here where the market hasn't actually managed to fill yet. There's also one up here. So again, they're just points of interest. I can also see that some form of equal highs have been created here. So that means that there's going to be liquidity just above. So we'll just delete that. So we know that there's liquidity above this, some form of liquidity. I'm not sure what. There is an institutional daily manipulation candle to be played off that almost got played off here. I mean, we were about 4 pips off of 4 or 5 pips off this. So it might well be that it's already played off what it wanted to play off, and it could run away. But I'd like to think that it's still gonna fill this displacement area here, and also fill this. And based on what current price action looks like in the last couple of days, it does still look bullish. I mean, there was the bearish move down, but it does still look like it's got some room to kind of push up more. This big long candle here didn't actually kind of engulf the last one, So I would like to think that it's going to kind of staircase its way up from now. So if we drop down to the 4 hour, let's see what that imbalance is looking like on the 4 hour. Yeah, so again, equal highs. It's played off it. It's quite a sensitive area. And for me, actually, what I would do, this is where my entry would be. You can see here that the precise entry is the 1.32 100 area, but I would have my entry at the 1.32. This precise entry is the 1.32 108, but I'd have my entry at 1.32 108. That was a big mouthful. But yeah, my entry would be 32 100 because that's much more of a rounded off number, and it's kind of like a psychological number. That's what John Dollery calls it. So yeah, that's where my entry would be, and also it correlates quite nicely with being near the 50% mark of this imbalance. Which is around about here. And then also if we have a look at the fibs, maybe go to the daily for this. It does correlate quite nicely with our kind of golden pocket regions. So this one particularly would correlate nicely with Starboy's kind of Starboy's fib regions. I would personally have this set up. I'd have it just above the institutional candle around about here. So around about 45 pip stop. I'd have probably my first target around about here, or I mean, I'd probably have 3 targets and take some partials around about sort of like the 100 pip mark. I'd imagine this is quite a big area here because there's an area of imbalance, and you know that the most amount of volume in that area of imbalance is around about the 50%, and it looks to me like the 50% is around about this 1.31 mark. So that's also another correlation, which is a very round number. So that would be a good target. Just before that, just to be safe. So around about 100 pips at 1.31079. A second target around these lows, around that build up of liquidity, just here. So that's 173 pips. And probably a third target challenging these previous lows. So that's 250 pips. And if the measured move does end up pulling through, then we could end up seeing something like this to happen. For a final target that will reach around about the minus 27 fib range. So that is that, guys. Please drop a 1 in the chat box. I know that is a lot of information, but if you followed most of it, or if you followed it, just drop a 1 in the chat box. Let me know how you found it. I'll be doing some more sessions like this, I think. But yeah, so I mean, one of the things about this is that partial profit taking is key. And if you get around about 40 pips up in any given trade, then 40 to 50 pips, I'd say move your stops to break even to manage your risk effectively. And partial profit taking is key. So if you see that around this area or around any area, the market's starting to filter out, it's starting to slow down, then take some partials, man. You can't go broke taking profit. You really can't. I mean, even here, you can see here that there's been just pure wicks and no bodies. So even that could be a nice little take profit. I mean, if you're happy with what you see, then take it. Don't be waiting for loads more pips and waiting and have kind of fear of missing out or anything like that. Just take it. Secure the bag. Literally secure the bag. So again, I'd take some partials around about, I'd probably take some partials around about the 40-50 pip mark. That's kind of my rule of thumb. I'd take some more maybe around about here. I'd take some more around about the 100 pip mark, and I'd take some more around the 180 pip mark. And and then if need be, you can just leave a small amount of your position in here, and then you can hold out for this 360 pip move, this big 360 pipper. So yeah, that's that, guys. I'm going to wrap it up. I know it's quite late. Sorry that I've kept you all so long. And I do apologise for the technical difficulties before. I'll try and get that fixed for next time. But yeah, carry on watching. Or if you haven't started watching, start watching steady and start watching the sessions and tuning in. Because that's how this kind of stuff, it might sound a bit alien to you if you're hearing it for the first time, but that's how it's going to start coming together, and you can start making some money and become independent traders, because that's what the goal is at the end of all this, right? You don't want to be taking signals all your life. You want to be able to trade independently and create some real wealth out of this. Because God forbid if anything ever happened to IM or John Dollery or whoever, you don't want that to be the end of your trading journey. So take care, guys. Trade safe, and I will see you all next time. And I'll stay on for a bit longer just to catch any questions that you might have at the end. And yeah, that's that. So yeah, let me know if you have any questions, if you want to stay on, but you feel free to leave the call if you're all good. Cheers, guys. Yeah, Benji. Yeah, I'll drop that in the chat. I'll drop that in the WhatsApp. I'll drop that in the WhatsApp group for you to get 1 and 2. Cool, no worries. Cheers, Emily. Cheers, Chanel. Yep, no worries, Joe. Yeah. So what I would basically have my stop loss as is it will always be above the institutional candle that I'm playing off. So in this case, it is like kind of just above, and it doesn't always have to be kind of above the wicks. So for this example, because it's kind of a 45 pip stop loss already, it's not the smallest of stop losses. So I would have it kind of just above, um, just above here, but still in the wicks. But I think it was this trade that I was looking at previously. If it's a smaller stop, you can kind of afford to. Let's see. So if you can see, I don't know why it's looking like this. Not too sure what has gone on. Okay. So right, let's just make this green. So this is the 50% of the institutional candle on the 4 hour, the last down move before the up. And if you look over here, that is where my entry in particular would be. And so just below this institutional candle, that's where I've got my stop loss. But you can see for this one, you can afford for it to be kind of a bit further below below this point because it's kind of a smaller stop. But usually you just have it where the wick is. It's still safe to do. That's what John Dollery does. But for me, just personal preference, I do prefer it to clear the whole candle, you know. But John Dollery, he'll have his kind of above these wicks and stuff, and he gets on just fine with it. I just prefer it. I just think that way is a bit more safe. But yeah, so that is how you have the stops. Okay, I hope that makes sense. Anyone else got any questions?